today's video, I want to discuss how to avoid these costly mistakes that I've actually made as I began my career as a loan officer. Now, if you're trying to get this information, then please hang tight, grab a paper and a pen. I think you're going to enjoy this video. So with that, let's dive right into it. Discuss down payment options to eliminate loan options. Here's the deal. A lot of times as a beginner loan officer, you're not necessarily going to know all the programs that are available. And so you might drift into different conversations that are going to suck up a bunch of your time. So what I would highly recommend to do is just know that one of the biggest benefits of having an owner-occupied loan is the fact that you could actually put down a very minimal down payment, as low as 3% down. Now, here's the thing. A lot of people translate that into any other type of a loan, meaning that you might get a self-employed borrower who thinks they could get away with using bank statements to qualify and still put down 3%. And that does not exist. The reason I bring that up is I've had so many different conversations with borrowers who simply tell me, yeah, could you tell me about all the different programs that you have? And then I ask them, what is this for? Is this a purchase, refinance, cash out, owner, investor? What are you trying to do? I'm like, oh, we're trying to buy our owner-occupied property. And I'm like, great. How much of a down payment do you have? And they say, well, we are trying to come in with the least amount possible. Next question is, how much is the least amount possible? In which they reply 3 to 5%. That basically just eliminated every single loan in the book except for either agency or FHA. So if somebody's going to come in with 5 to 3% down or 3 to 5% down, they can only get an agency loan or an FHA loan. And it must be an owner-occupied loan. It cannot be an investment loan, because the benefit of being able to buy a property as an owner-occupied is the first time around to be able to put down as little as 3% down. If you're going Fannie Freddie Mac, or if you're going FHA, it's 3.5%. So bullet number one, just make note, don't waste a ton of time talking about all your loan products. Just find out first how much of a down payment the buyer is working with, and then that would basically dictate what kind of a program you could actually do for them. So that was mistake number one. Wasted a bunch of time with it. Hopefully you won't. Moving on to number two, quoting rates and fees. Here's the deal. A lot of times you're going to get engaged in a borrower who wants to ask you so many different questions about different programs that you have when they actually either can't afford the program or don't want to pay for the program. So what I would highly recommend to you to do is give them a general framework of what a program like this would look like. Example, if you're quoting a first-time home buyer and it's under 20% down, make sure to let them know there's going to be mortgage insurance. It's kind of like insuring anything else. You know, the more you insure, the more it costs, meaning the smaller the down payment, the higher the mortgage insurance premium. Also, that means the payment goes up. Question now, with a high premium for mortgage insurance, will they actually qualify? So before you jump through all the hoops, give them a general idea of what you're working with. Because I'll tell you this, 9 out of 10 times you're never going to be the cheapest rate in town. And if you're in a broker shop or a direct lender, many times if they walk into an institutional lender, not all the times, but many times, they're likely going to be able to beat your rate. And if they do, then what? You wasted a ton of time with someone who's not even going to use you because you're getting an eighth of a rate less than whatever it is you're offering them. Hopefully people are using you for your expertise, your knowledge, your service, okay, and your competitive rate. But if it's only for a competitive rate, remember, somebody else always has a more competitive rate. So watch out for that. That's number two on our list. I'm gonna move on to number three. This is a big one. People have always come through the door, not always, but from time to time, I should say, and they're in a panic to get a deal done. And they're like, oh my God, I have to close on this like in a week. Can you put this together for me? I have all my documents. In the beginning, when I didn't have the level of expertise that I do today, it was enticing to say, yes, let's try to get this done, knowing that it's gonna take more time and you're gonna need to ask for extensions. However, my recommendation is this. Be very forthcoming and just let them know it's not possible. No one can close a deal in a week. As a matter of fact, from the time a lender's estimate goes out to the time the borrower acknowledges to the time that you're able to close is 7 days. You cannot close escrow any quicker or a loan any quicker than 7 days from the time that the borrower acknowledges the lender's estimate and 3 days from the time they acknowledge the closing disclosure, which is your CD. So even if you wanted to, it's not possible. I would highly recommend to stay away from massive rush requests because 9 out of 10 times, if not more, you end up wasting your time. That's been my personal experience. It basically just falls apart because everyone is trying to put something together that's never going to be able to put together. Number 4, it's okay to say no. Can't tell you how many different creative ideas people have called me with, saying, hey, I have this property and I'm buying it for $100,000 under market. And, I need 100% financing and I'm going to use it as my, investment property. And the stories just go on and on. So when you start hearing things like this that don't line up along the portfolio of programs that you have in the boxes of loans that you're going to be able to offer, just say no, because at the end of the day, you're just going to be wasting your time. And unfortunately, even though you want to provide excellent customer service, you want to build a book of business, and you definitely want repeat customers, you don't want to set an expectation that's not logical. And you rather let that borrower go and focus on deals that you can actually earn a commission on. Remember, your time is valuable because you're not earning a paycheck, you're working for commission. Just something to keep in mind. Number 5, know when it's a hard money deal. So what happens is many times people bring a property that's not financeable. As an example, a property had fire, a property is missing a kitchen, there's no floors, there's no bathrooms, a part of the roof is missing. Different things like that are basically work in progress. There's a reason why they're getting such a great deal on the property. It's because it's not something that the bank can finance. And those things happen both in the residential world and in the commercial world. And in the commercial world, it's even worse because when something cannot be financed, typically means that there's an issue with contamination in the land. It's not something we're gonna get into, but you definitely want to know when it's time to say, hey guys, if you really want this property, if you're competing with 10 different offers and they're all cash offers and we can't, get conventional financing because the second the appraiser goes out there, it's just going to come back and fall, then I would highly recommend at that point to make it a hard money deal. Just close on it, which again leads us back to not 3 or 5% down, minimum 25 to 30% down, and then be able to get into that fixer up or whatever it may be, turn around and then get a conventional loan on it. It's very important. I can't tell you how many times this happens to me in the past, so I hope it doesn't happen to you. Number 6, do not refer what you cannot control. And the reason I say that is because there was a time where I was trying to help out different borrowers who just didn't fit into any particular bucket of loan. I knew of different stated programs that may be available out in the market. However, they were on a retail level or a level that I couldn't control, none whatsoever. I knew that these loans take longer and I knew that the process is not fun. I actually let the borrowers know that upfront. However, because they listened to my advice and I told them I personally would not take that route. However, it is available. It's not a fun route and it takes a very long time. They went in that direction. They had a bad experience. And then that bad experience was a reflection of me. So I would honestly say never refer anyone, even that there's a solution available, but it's not a very good solution or might take a very long time to put together. I would highly recommend to stay away. Don't refer, just let it be. Number 7, if it's empty and it's under renovation, you're not getting an owner-occupied loan. So many people decide that they're gonna reno their primary residence, or they bought a property and it's been more than 60 days and they can't move into it because they're doing a renovation, and then they decide that they want to get a better loan. You're not going to be able to offer them a loan simply because when you do a transaction, typically a purchase, you have to take possession within 60 days. And when you do a loan, at application, you have to occupy the property, which means that if the property is vacant and an appraiser goes out there and goes, it's vacant, then you're just not gonna be able to get a loan on it. So I would highly recommend that if somebody is in that predicament, you let them know to either get a private money loan to get their finances sorted out, or wait until they occupy the property. So the day you take an application, they're in the property, and when the appraiser goes out there, he sees that they're living there, especially if you're doing an owner-occupied transaction. Number 8 is a big one. It's called trigger leads, kill deals. What is a trigger lead? So anytime you pull a borrower's credit report, they turn into a trigger lead. Now, personally, I don't know how that's still legal, and it is being fought with legislation. However, anytime you or anyone else pulls a borrower's credit, they automatically become a lead that you could purchase for approximately $1 from the credit bureaus. And then you call that borrower and you try to compete for the business. Now, I personally have never worked with trigger leads because I don't think a trigger lead would value my expertise, my knowledge, nor would they know who I am. I could be anyone. However, a lot of people do buy trigger leads, and the second you pull your borrower's credit, then 500 people call them to try to offer them a better deal than what it is that you're offering them. So I would highly recommend to let your borrowers know in advance that that's about to happen. Personally, you could actually use the company's fax number to insert as the borrower's phone number with their consent, so they get, a little bit less solicited. However, because your phone number is on social media, more than likely it will get pulled into the lead regardless. There is one way to avoid it. It's called opt out. There's a website that I would link to the bottom of the description of the video. And if you actually register on that website, you will be opt out of being a trigger lead, which I think is amazing. So definitely look for that link, because I would highly recommend using it. Number 9, flipping an owner-occupied to investor will remove the rental income piece. So if you're in a transaction and you're doing an owner-occupied deal, and for whatever reason you're unable to close that transaction, most of the time it would be because you're not getting enough income to qualify, and so you might consider that transaction to be flipped to an investment property, especially if the borrower doesn't live in that property just yet. Maybe it's something that they bought, maybe it's something that they're fixing up, maybe they want to move into it, but it's been more than 60 days, they're still not living in it. So if you present it to the lenders an owner-occupied transaction and they're not living there, they're living somewhere else, and then you decide, you know what, I don't qualify because they don't make enough income, I need rental income from that property to qualify, and you flip it from owner to investor, you will no longer be able to use any type of rental income if the lender has that overlay, which a lot of them do, and that means that transaction is going to fall through the cracks. So something to keep in mind, if an owner has an empty property that they're working on and they don't live there, consider putting it together as an investment property, not an owner-occupied property. Last on our list, check about my commercial course. Well, I'll tell you this, among all this amazing things for residential financing, we do a ton of commercial financing, and I can tell you that there's a lot less red tape, and commissions in the commercial world tend to be a lot larger. That's why I developed a system or course called the Part-Time Lender Academy, and I'm going to link a description or a link in the description below so you could check it out. I'm currently building a waiting list for the course. It's a great course. You could do it from anywhere at any time and start building yourself up if you're interested as a commercial loan officer. And so the commissions are amazing and you can do it on your own time. And so I would highly recommend learning about it. That's kind of how I got started. This has been the great foundation for lending, but I think taking it a step further is in fact getting into the commercial deal. So if you're interested, check it out in the description below. I hope you enjoyed this video. I hope you got some value out of this video. And if you did, please let me know in the comments below. Let me know what you've learned. Let me know what you have questions about, and I'll be happy to answer them. Otherwise, I appreciate you. Thank you for watching this, and I'll catch you on the next video. Take care.